Is it time to start worrying about global recession, or are we premature again? As stock markets rise today, seemingly shrugging off all manner of bad news from last week. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive, coming to you back from a week away from markets, looking at the dust settling after last week's fireworks and trying to figure out what's next, which is exactly what we're going to do here on Macro Money. We're going to ask, is it in fact time to get worried? Because there is some sense that, in fact, it might be. But we're getting into an interesting part of the year here. The first part largely spent on things that at this point seem more like distractions in the larger narrative. Obviously, they seemed weighty at the time, some more than others. The banking crisis, obviously one of them. The debt ceiling debacle in the U.S., the other. First one, much more substantive than the latter, in my view. But now that we are in the back half of the year, we are starting to get into that window that the Fed has been telling us about, where their rate hikes should start to inflict some really potent pain. Fed has told us that it takes between 12 to 18 months for a single rate hike to be absorbed into the real economy. We are now just about there, considering we started this rate hike cycle in March of last year. So, is it now the time to get concerned? Well, an interesting sort of preview for us on this score when we look at how the markets reacted following July's U.S. jobs report released last Friday. And from that, an interesting setup for some key U.S. data and some key Chinese data on the menu for this week. So let's take a look at and see what it was after the U.S. jobs report that was so eye-catching, and then perhaps what we see this week can extrapolate and tell us, are we in fact starting to enter the proverbial danger zone? So this is the response to NFP. Now, the numbers themselves were fairly benign. The headline jobs number, a little bit softer, 185 relative to about 200 expected. The unemployment rate a little bit better, 3.5 relative to 3.6 expected. Average hourly earnings, the wage inflation number, possibly the biggest point of interest, 4.4% against 4.2 expected, so a little bit hotter on wage inflation there. The market's looking at this saying, well, this is good. This means that the Fed does not need to be very aggressive on rates, and this rate hike cycle is probably done. Consider the initial response. And I stress initial, because after a few hours, things started to look very different. Here it goes. Fed rate hike odds for end of year. This is the December Fed funds rate implied in the futures market. Down. The 2-year yield, down. The 10-year yield, down. The dollar, down. This green line is the euro. Of course, it's priced in dollar terms. We're looking at the future here, and the euro by far the most liquid counterpart for the dollar. And when we look at the construction of the dollar index, it's mostly euro. So a lot of those currencies in that average have become the euro since it was introduced. So what we have here is the dollar falling, gold rising, stocks seemingly nonplussed. And then a few hours go by. And what happens into the close starts looking very different indeed. Consider right here. Rates aren't going anywhere. They're staying near the lows, as are policy expectations. But suddenly, stocks crack, and the dollar starts to reclaim some strength. Now, it's the disconnect between what's going on in yields and the dollar as stocks fall that really seems to be the most interesting part of this story. Gold, as ever, looks at yields and says, well, they're down, so that's good for me, but the dollar is up, so that's bad for me, so I'm just not going to go anywhere. Not really a convincing response in the second act from bullion. But very interesting to see the dollar first fall as yields fall and then rise as they don't go back up. The difference, of course, this sharp move from the S&P. And the upshot, a kind of classic risk aversion, where the dollar is taking its cues not from yields per se, but from the unwinding of risk exposure and from capital going from assets to cash, and of course, the cash of choice being the most liquid, the most ubiquitous currency in commercial use. And that, of course, is the US dollar. Take this opportunity to just remind ourselves, talk of de-dollarization, as far as I'm concerned, utter nonsense. That aside, this seems to give us a situation here where the market isn't so much responding to a slightly weaker jobs report that doesn't send the Fed running to raise rates again, but more so a concern about growth. If stocks are falling and the dollar is rising, even as yields stay down, this suggests yields did the correct thing. There is a growth concern here. Maybe things are slowing down, at least enough for the Fed not to need to go aggressively from here. The dollar is strong, so there is a degree of risk aversion. Stocks are weak, so there is a degree of risk aversion. And the dollar is going up not with yields or for rate hike reasons. All that seems to suggest the markets are starting to perceive that perhaps now we're entering into a window where we need to be concerned about the business cycle, not what the next move in rates is going to be, 25 or 50 up this month or next, as we've been focused on really since the middle of 2021 when the Fed threw in the towel on this inflation is a transitory thing narrative, incidentally, as we expected that they would, and would shift gears into this more hawkish setting that we find them in currently. So, we've seen this movie before. We've seen elements of this before perk up in the economic data over recent weeks and months. When you get a number like this and the markets don't seem to be responding so much to the number per se, but to the passing of the number. And then finding a default that seems to belie a growth concern starting to come into view. Well, this week we're going to test this theory with a range of numbers out of both the world's second largest economy, China, and of course the U.S. itself. Let's begin in China. This is a sequential thing. That data will come before we get U.S. numbers. And the first set of things to look at here, another ostensibly dismal trade report. You can see what's been going on here. The decline has been precipitous in both imports and exports, telling us a story about a Chinese reopening post-COVID that happening in December of last year that isn't really gaining any traction. So weakness, again, on the imports side, speaking to soft domestic demand, weakness on the export side, again, telling us about weakness in external demand, none of it boding well for the world's second largest economy having very much of a positive contribution to the global pie, especially at a time when the Eurozone is in recession. So it's really the U.S. holding up much of everything. Second set of numbers here out of China, very much in that same vein. Inflation expected to actually come in negative. You can see baseline CPI is the yellow bars you see in the back there. There's not a bar missing for June. It's just zero for that month. Inflation was flat. That would be the weakest it's been since early 2021 on the way out of the initial sort of wave of economic weakness following the COVID pandemic. And what you see is this consistent deceleration from about the middle of last year, largely echoing the decline in food prices, attempting to perk up a little bit as those food prices did, but ultimately not having any luck. All of this still speaking to weak domestic demand. You can see CPI excluding food is, for lack of a better term, sinking like a rock. So the expectation now is we're going to get another negative number, 0 in June and negative 0.4% in July. All of it, just like the trade numbers, speaking to weak performance in China. Now, to quickly review where that's coming from, consider we had the peaks in catch-up growth after the pandemic in the U.S. as early as May of 2021. That's where reopening and a massive amount of stimulus came together to give us surging growth. That was the peak. Then, of course, shortly thereafter, the Fed began a rate hike cycle that helped to drive things down. The similar peak for the Eurozone, those two, of course, China's biggest export markets. That's where the rich world consumers are, after all, and China is the leading value add, middle of the global supply chain center. Still, raw materials tend to come out of much of the world, go to these value add places, China, of course, the premier among them, and then get shipped on to end demand in rich world markets, in particular the US and the Eurozone. Well, growth in those export markets peaked long before China decided to turn its economy back on in December of last year. And so you can see it reopens into significant slowdown. And by March of this year, that reopening, benefiting from a bit of a premium in reinvigorated domestic activity, starts to come apart. And now things are once again heading lower. These are, of course, PMI numbers. They're operating on a logic where 50 is neutral, under 50 is contraction, over 50 is expansion. So you can see the U.S. is in expansion. The Eurozone, that blue line there, now under 50, so in contraction, in recession. The situation in China, both the official numbers, CFLP, and the private sector estimate, which tends to focus on smaller size firms, Caixin, both of those measures of Chinese economic activity growth pointing firmly lower and continuing to decline. So the issue seems to be that China was offline for longer, and that means that as it's come back, its end demand markets just aren't there like they used to be. And that's why this economy can't get off the ground. That's why we see these abysmal numbers. Looking at the latest performance for economic data relative to expectations from Citigroup, we can see Chinese economic data has tended to underperform. Not only is it under 0 on this index, which means data has tended to come out weaker than anticipated by economists, but it's trending down. So not only is it underperforming, but in recent weeks and months by an increasing margin. There's been a little bit of stabilization here over the past few days, it would seem. So looking at all of this, there seems to be a meaningful risk that these inflation and trade numbers might underperform expectations. That, of course, would suggest that, in fact, we are looking at an increased risk of a global recession of some sort building. If in the wake of those kinds of numbers we were to see, again, a stronger US dollar, weaker stocks, a stronger yen, lower yields, higher bonds, perhaps a weaker Aussie dollar in particular, which tends to be especially sensitive to China's business cycle. Of course, China is Australia's largest trading partner, and the Aussie is something of a bellwether for cyclical assets. If we were to see those kinds of things, well, then we would start to get a sense of, yes, the market is starting to worry that the business cycle itself is turning over. This will set the stage for what is probably the biggest event on the economic calendar this week, Thursday's U.S. CPI report. Here's what we're looking at there. We'll break down the makings of what's going on here. The expectation is we're going to rise from 3% in June to 3.3% for July on the headline number. The core number seen edging down a tad from 4.8 to 4.7. We can see here what the Fed has been talking about all this time. The bulk of this is services excluding food and energy. In fact, energy is now a negative contribution to inflation. It's actually pulling it lower. You can see that yellow area on the bottom there showing that. Goods inflation has been squished to next to nothing as far as a contribution, in part because of the slowdown in global trade, in part because supply chains have, in fact, been addressed to a large extent, so shipping costs are down. Distributive costs, getting goods moved around the U.S. economy, those are down. So there is much less of that in this pie. So those elements, as the Fed suggested, were in fact more transitory than not, although their own actions have certainly helped to drive this cool off faster. Food inflation is still a bit of a thing, but it's nothing like the contribution from core services. And herein is where things get interesting. Now, looking at what the market thinks, we get a sense of why the Fed might be worried. Inflation expectations haven't really done much of anything in months. We can see here in the yellow bars the 2-year break-even rate. That's the 2-year inflation expectation that's priced into the bond market, right within the Fed's outlook window, I might add. The 1 year is the inflation swap measure of inflation expectations, a little bit shorter term. You can see it follows very closely with what's going on at the break-even. That's the orange line there. And they've been idling basically through the second half of last year and going into now, even as inflation has been moving lower. You can see inflation lags those more timely market-based expectations, the actual realized outcomes, lag it by about 2 months. We've lagged it back here. You can see it lines up really clean with the tops and bottoms. From the Fed's perspective, this is not a whole lot of margin for error. They need to get to 2% inflation. That's their statutory mandate. What this is telling us is the market does not think that everything that's happened almost now over the course of a year has moved the needle very much. And so what we're looking at is essentially an outlook that's priced for perfection. If the Fed gets to 2% in 2 years, which is what the bond market seems to be saying here, on current trajectory, well, then nothing at all can go wrong for 2 years. If it does, well, then the Fed is offsides and it needs to do more. It would be much more comfortable if the 2-year break even were lower than target so that it could cut into raising inflation or letting it rise into where they want to be. Same thing for the inflation swap. It's sitting north of target, but again, it isn't moving. And that's a concern. Now, if we get this uptick to 3.3%, it would be the first real uptick since this disinflation started back in June, or since June of last year. July was the first month of disinflation last year. Which brings us to what is the Fed's main concern and why this core services thing that we were just looking at, just to remind us, there it is, the biggest part of inflation is services excluding food and energy. Well, this tells us what that is made of, and it's primarily labor. We just got this NFP report, of course, last week, and also job openings data, so we can update our numbers on labor supply and demand. So as of June, there is still a gap of close to, let's call it, 3 to 4 million jobs between supply and demand. That's those blue bars there being below zero. Right there. And as you can see, where COVID started was a sharp oversupply. Not surprising there. Everybody got sent home. The global economy got closed. As it got reopened, more people came into jobs. Inflation started to rise. And now we are in an undersupply situation. We've managed to squeeze as much as we can from the goods side. That's the move from the peak in June of 9.1 to the trough, maybe, last month at 3. And as we've been saying for a while now, going forward, it's going to be very difficult to get that year-on-year inflation number to continue to go down because you're no longer comparing with something that's rising. In fact, in June, you're comparing to the absolute peak. So, of course, you have a low number. But going forward, year-on-year comparisons will be to inflation that's already falling. These July numbers will be a comparison to last year's July numbers where disinflation has already started. With that in mind, it'll be much more difficult for the Fed to get this moving. What does this mean in terms of rates? Well, currently, expectations suggest that the rate hike cycle is over. No chance of a hike in September. That's a mere 12% here. The probability gets a little bit warmer as we get into November, a cumulative 36% chance of a rise once you take the 12 and the 24 together. And then you start to see a topping and a move in the direction of cuts. The first cut you can see all but priced in by March, 77% chance of a cut there. It's fully baked in by May, and then some. There's actually a further almost 50% chance of 2 by then. We then see a brisk cutting cycle. 3 cuts by July, 4 by September, 5 by the end of the year, flirting with maybe even the possibility of 6, although that likelihood fairly light here at about 30%. So what then of the CPI number? Well, unlike China, the trend in U.S. economic data surprises has been higher. U.S. economic data has tended to outperform relative to forecasts, indeed by an increasing margin. And so what we set up for is the possibility that the U.S. CPI number might actually give us not 3.3, but maybe 3.4, 3.5%. Well, if that's the case, then the Fed is going to have an even harder time still making this make sense. It will be that much harder for the Fed to say, well, we're priced for perfection. We're going to get to 2% in 2 years. You get a higher CPI number, and suddenly that looks less likely. And of course, the Fed already doesn't like what's going on here. And so the problem becomes, what do you do? Do you then raise rates? Well, maybe not. Maybe you wait and you consider that the 12, 18-month lag for rate hikes to be absorbed into the economy should be hitting right about now. So you look at this and you say, we are going to see this imbalance work its way down as the impact of rate hikes hit in earnest and in full. But of course, what that means is that we're hurting growth, because you're not going to fix the supply-demand imbalance ostensibly with more supply. We don't have a way to make a ton more skilled workers out of thin air, after all. And even if we wanted to import them, there doesn't seem to be a particularly strong appetite for a large-scale immigration program, especially as the run-up to the 2024 election cycle starts to get underway. So the only way to really fix this, from the Fed's perspective, seemingly, is to hurt demand. And maybe they don't rush out with more rate hikes if you get a hot number. But perhaps some of the easing that's already baked into the back half of the forecast here, maybe that gets watered down. Maybe you don't get aggressive rate cuts that stay in the forecast after a CPI number that prints higher than expected to this extent. Maybe the start of the easing cycle is pushed back, and maybe its amplitude flattens. What all of that would suggest is that there needs to be a repricing on growth being weaker. That would be a risk to the business cycle. Higher borrowing costs hamper growth, and in fact, that's exactly what the Fed wants them to be doing, so that this can be addressed. And so you put that together with weak data out of China, and suddenly, with Europe in recession to boot, there is a global recession risk. And the kind of dynamics we saw in the wake of the NFP report, in particular, this part of the story, flattish gold, higher dollar, weaker stocks, rates starting to get heavy, that may start to become closer to a trend that is defining for the second half of this year. But of course, we need to see the data. We need to see the evidence. We have ample opportunity this week to get a preview of just that. And that is Macro Money for today. Thanks very much for joining me. I am here back in the saddle Monday through Thursday every week, right after overtime with Chris Vecchio, head of Futures and Forex here at tastylive, where we break down each day's price action and try to figure out what all of it means. I'm also on with Chris for Futures Power Hour on Fridays, then on with Tom and Tony for First Call on Sundays. I'm writing for the News and Insights section of tastylive.com and opining on Twitter, yes, Twitter, at Ilias Pback. Thanks very much for joining. Happy trading. See you tomorrow.